Hello class and welcome to week 1 of Accounting 250, Principles of Accounting 1. This week we're going to start the basics of accounting. We're going to start learning a little bit about different accounts and what's called something called the accounting equation, etc. So one thing you should do is you should check out your Blackboard, and in Blackboard under learning activities, so if we go to the course, I got to find the right course, sorry. You know what, I have this over here. One second. Okay, so in the course, if you go to learning activities, and then if you go to week 1, yours looks a little different than mine. In fact, let me turn on edit mode so it looks more like yours. We want to go to reading and study. So under reading and study, we have our unit 1 handout right here. Go ahead and download that. That's what we'll be working from in this video. So here we go. The first part of the handout says classic upholstery shop. And this is just an example. We're not going to be answering this question, but this is to get you an idea of what we will be doing as we move through this course. So the classic upholstery shop narrative says Tyler Smith has worked in an upholstery shop for 10 years. Last year, Tyler's wages were $20,000. Lately, Tyler has been unhappy with the shop's owner. Convinced that he could run an upholstery shop better, he run an upholstery shop that did better work at lower cost, Tyler decided to go into business for himself and opened Classic Upholstery Shop. To get the business going, Tyler decided to invest heavily in advertising. He spent $6,000 on advertising aimed at consumers and another $2,000 on advertising aimed at getting work from interior decorators and interior design stores. Tyler also purchased industrial sewing machines costing $4,000 and other tools and equipment costing $3,000. He estimated that the sewing machines can be used for about 5 years before maintenance costs will be too high and the machines will need to be replaced. The other tools and equipment are not as durable and will have to be replaced in 3 years. At the end of the first year of business, Tyler had received $80,000 in cash from customers for upholstery work. Tyler was owed another $2,500 from customers who are not required to pay cash but are billed every 30 days. And then a review of Tyler's checkbook shows he paid the following expenses, in addition to those mentioned previously, during the first year of business. He bought upholstery fabric for $40,000, other supplies for $10,000, wages for a part-time assistant were $9,500, rent was $4,800, insurance for a 2-year policy was $3,200, utilities were $2,500, and miscellaneous expenses were $1,700. Tyler's utility bill for the last month of the year has not arrived, but he estimates that bill to be approximately $320. Tyler keeps some stock of upholstery fabric in popular colors on hand for customers who do not want to wait for special order fabric to arrive. At the end of the year, about $14,000 of the fabric purchased during the year was in his store stock. In addition, $2,300 in supplies had not been used. How much profit did Tyler make in his first year of business? Do you think it was a good idea to open the upholstery shop, or would Tyler be better off with his old job? Wow, what a lot of information. And I'm sure just reading that, you feel probably a little bit overwhelmed. Well, obviously, you don't know what to do with all of these numbers yet, but we're going to learn in about 8 weeks here what to do with any of these examples that we just looked at. But we got to start, and we start small, and we have to walk before we can run. So in order to do that, we have to go over some basic accounting principles. So there's a few basic accounting principles under what we know as the generally accepted accounting principles, or GAAP. So GAAP equals the generally accepted accounting principles. Okay, and some of these principles are the objectivity principle, the cost principle, the going concern principle, monetary unit principle, revenue recognition principle, and the business entity principle. So objectivity, I'm going to go over these briefly, very briefly. Objectivity basically states that accounting is performed objectively by not necessarily a party that's completely objective from the entity, but with the objectivity principle in mind, meaning not to benefit the business or owners or somebody else necessarily, but just to record transactions as they occurred. The cost principle, transactions are recorded at cost. Inventory and assets are carried at cost. The going concern principle is a principle we use in accounting to state whether or not we believe an entity can continue business operations as it is right now. So if an entity is a going concern, we would be concerned whether or not they could continue business. They are at risk of being bankrupt. The monetary unit principle states that we record accounting transactions using monetary units. In America, we use dollars. We don't use anything else but monetary units. No trading values, no goats, sheep, and we use dollars, not yen. If we were in Japan, we'd use yen. The revenue recognition principle states that we recognize revenue when it is earned, not necessarily when we receive it. And then the business entity principle means that accounting records represent a single business entity. They represent the business. So what about transaction analysis? So these are the three main types of accounts in accounting. These are what we call permanent accounts. And they make up what's known as the accounting equation, which is listed here. The accounting equation is assets equals liabilities plus owner's equity. So assets are things that the company owns, such as cash, inventory, right? Accounts receivable, which are rights to receive money from somebody at a future date. Hard assets like cars, machinery, etc. Liabilities. Liabilities are something the company owes, something we owe, which is things like accounts payable, mortgages payable, notes payable, etc. And then owner's equity. Owner's equity is a representation of the ownership of the company, its ownership. And it's made up of initial investment and net profits or net income for the organization. So this is the main part, though, that we need to remember. Assets equals liabilities plus owner's equity. This is what's called the accounting equation. We have to remember that. So we utilize the accounting equation much like any other equation in math, in that an accounting entry has to keep this equation in balance. So if we add to the assets, we need to add to this side, or we need to subtract equally from the assets side in order to keep the equation in balance. So what does that mean? Okay, so assets. If we purchase something with cash, we subtract cash, so we have less cash, but we might add inventory. And that's both on the asset side, so liabilities plus owner's equity stay the same, but we subtracted one asset for another. Now what if instead we buy an automobile? So we add automobile, this is an asset, but we don't pay cash for it. We take a loan on that automobile, which is a liability. So we add to liability, or note payable, which is a type of liability. So we added something to each side of this equation. So we have to be careful to keep the accounting equation in balance whenever we're making entries. Now, something we have to understand how to do is how to record some transactions. Okay, so we are going to go ahead and record a few of these transactions, but I'm going to use Excel because I think it's a little bit easier than writing into here. So we're going to record these following transactions, and we're going to talk about what sort of accounts we're going to use in doing this. So these are the accounts that the example gives us to use. So we're going to use any of these accounts: cash, accounts receivable, supplies, lawn equipment, accounts payable, and J. Hamilton Capital. In the last column here, for this little thing, it's going to ask us for the account type. So we're going to set something up here where we do that in Excel. And the types that we have are investment, revenue, expense, or withdrawal. Okay? So, this first transaction, Jim Hamilton began a lawn care business in May by depositing $800 in a business bank account. Okay, so before we do this, let's go back and look at this accounting equation. Notice assets are listed on the left-hand side and liabilities and owner's equity are listed on the right-hand side. This means that the natural balance for assets go left and the natural balance for liabilities and owner's equity go right. What we call this in accounting is debits and credits. Debit and credit, okay? So in accounting, we use the term debit and credit. For purposes of this week, think of debit as meaning left and credit as meaning right. Forget everything that your mind tells you when you hear the words debit and credit. You're thinking about your bank account, and that does not apply here. So debit means left and credit means right. So Jim Hamilton began a lawn care business in May, depositing $800 in a business bank account. So what he did is he opened an account for this business. We're not thinking about his own personal bank account. We're thinking about the business bank account now. And he added some cash to that business bank account. So we're going to use the cash account here. And he also did something. He opened his capital account. This is his initial investment. Remember, we said earlier that owner's equity is initial investment and net income. It should be net profit or net income. Sorry. So what he did is he opened his initial investment account, his capital account. So we're going to use J Hamilton Capital. Now remember, cash is an asset. It's something the company owns. It's the left side of the accounting equation. So we're going to debit cash for $800. And we are going to, let's go ahead and give it the decimals too, even though we won't use decimals. And we are going to add to this capital account as well because we invested in the business. And to add to that capital account, we need to put an entry on the right, which is a credit, because owner's equity or capital is on the right. So we're going to put $800 in that capital account. So this was an investment, right? Investment. Let's go ahead and add a column here so they're not right on top of each other. Type. And then we will bold and underline these. Okay. So that's the first entry. That's entry A. Now B, we purchased a lawnmower and other lawn equipment on account for $1,000. The key words here, we purchased lawnmower and other lawn equipment. We did it on account, which means we did not use cash yet. Notice we only have $800 in the business bank account, so we couldn't spend $1,000 in cash at this point anyway. So what we did is we bought an asset, we bought lawn equipment, and we took out a liability. In this case, the account we have available is accounts payable. This is a common account we will use frequently. So accounts payable is the liability account we're going to use, and lawn equipment is our asset account. And we're going to do this for $1,000. So what type of transaction is this? Is this an expense? Is this an investment? This is actually an investment. The reason why is this lawn equipment, we haven't used it up yet, right? It's a piece of equipment that has a longer term life. So this is an investment. Then we paid cash for supplies. So we bought some supplies. Look, we have a supplies account. This is an asset as well. And we paid cash. Now, these are both asset accounts, supplies and cash. These are things that the company owns. We increased supplies though. Remember, assets is on the left side of the accounting equation here. So to increase it, we use a left entry or a debit. And we need to decrease cash because we spent cash on these supplies. So we use a right entry or a credit to decrease cash. The next entry says performed lawn care services for credit customers and billed them $700. So this is an expense. I'm sorry. This transaction was an expense. The next one. So we performed lawn care services and billed customers $700. So we have two things here. We have an accounts receivable. This is the asset. We didn't get the cash. If they paid us cash today, we'd use cash, but they're going to pay us later. So instead, we're going to use accounts receivable. This is also an asset, accounts receivable. And we have lawn care services, right? So we don't have a revenue account that is listed here. We use the following column headings: cash, accounts receivable, supplies, lawn equipment, accounts payable, and J. Hamilton Capital. So we could use, ordinarily what we would use is we would use lawn services revenue or just revenue. So we're going to use a revenue account for now, and we'll talk about where that account's going to go here a little bit later when we get through these entries. But we billed $700, and this is revenue. Okay. Then in E, we received the cash that we were owed. So we're going to get some cash. We need to increase the cash account, which is an asset, right? The other thing we need to do is we need to decrease this accounts receivable. I'm going to show you, we use this abbreviation for accounts receivable, A/R. And for accounts payable, we use the abbreviation A/P. So you might see me using those abbreviations. So accounts receivable, we need to get rid of this accounts receivable that we booked in the previous entry because they're now paying us. So they paid us $700 cash. We're going to add that with a debit because cash is an asset. It's on the left side of the accounting equation. So we add to it with a left entry, which is a debit. Then the accounts receivable, we are going to reduce it. It's an asset, so we reduce it with a credit. So basically, we've zeroed out the accounts receivable because we have a debit balance, a debit entry here, and a credit entry here for the same amount. Okay, so in F, we pay $1,000 cash for the lawn equipment that we purchased up here in B. Let's go ahead and add. So this is A, B. Come on, Excel. Interesting. All of a sudden, I can't type in Excel. Okay. Give me 1 second here to solve this issue. This is weird. Okay. That was very strange. Okay. So, let's see here. Let's bring back up our... Okay. So, we have this entry here. Hold on. Oh, that's what I was doing. I was going B, C, D, E. So we know which entry is which. Okay. So in F, it says we paid $1,000 cash for lawn equipment purchased in B. So this is going to be entry F. And we look and we see at entry B. We see entry B here, and we have $1,000 accounts payable. We are paying $1,000 cash in this entry. So we're going to get rid of this accounts payable. Notice when we initially entered this entry, accounts payable was increased with a credit entry because it's a liability. So then to decrease it, we need to debit it. We need to debit accounts payable for the same amount because we're paying $1,000 cash. And to reduce our cash, we need $1,000 here. Okay, so this entry here, it's not an expense, it's not a withdrawal, it's not a revenue or an investment. We recorded the revenue here when we earned it. Here we're just collecting on it. This one, same sort of thing. We already made the investment when we made the purchase of the lawn equipment. Now we're just actually paying the cash for it. So we're not really going to classify that entry either. So now G says we paid for an advertisement in a local newspaper, $150. So we have an expense account. Okay, so it doesn't, this doesn't really give us an expense option because it probably wants us to book it to J Hamilton Capital, just exactly what it wants us to do with revenue. But I'm gonna book it to the correct account, and then we'll talk about how that affects capital after we're done. So we're gonna use advertising expense as an account, and I believe it said we paid cash, right? Cash. So an expense account is increased with a debit, with a left entry. And the reason why is it's a direct contra to the capital account. So remember when we look up here, when we increased the capital account with our initial investment, we increased it with the credit. Now, if we look back up here to our owner's equity section, this represents our ownership. So it is our initial investment plus net profit or net income. So since an expense serves to reduce net income, it also reduces the capital account. So we're going to have 150 here, 150 here. So that's why an expense account, since it directly reduces the capital account once it's closed out later on in the accounting cycle, it is a debit to increase that expense because it's a direct contra. It's in direct opposition to the capital account. Same reason why our revenue here was a credit, because a credit increases the capital account, or exactly. So the capital account increases with a credit. Revenue also increases the capital account. So in order to increase revenue, we also need a credit. So they have a direct relationship, revenue and capital, whereas expenses have an inverse relationship with capital. Okay, so for H, we performed lawn care services for cash customers and immediately received $420. So we received cash and we had lawn care services, which were using the account revenue. So we're going to go 420, 420. Now, what I'm going to do is I'm going to say J Hamilton Capital, because this chapter is actually asking you to directly use the capital account. But in future reference, or in future chapters, we'll be using revenue or income accounts, and we'll be using expense accounts instead of the capital account. But I want you to understand what this chapter is asking you to do as well. So this last one here. Oops, I'll just use that. It's not letting me copy paste. Excel is acting strange. There we go. Okay. So then in I, we paid wages to a part-time assistant for $85. So for I, I'm sorry, and this is revenue. And this expense up here was an expense. Can't forget to do that. Here we go. So now let's go back to I. So we paid wages to a part-time assistant for $85. So we have basically an expense account. We'll call it wages expense. Remember, in this case, for this chapter, we're hitting it directly to the capital account. So I'm going to put that in parentheses there. And we paid cash. So in order to reduce the capital account and book an expense, same thing, we use a debit entry for $85. And in order to reduce cash, we use a credit entry, $85. So this is an expense. Now for J, we perform lawn care services for credit customers and billed them $600. We've done this once before, right? Accounts receivable and revenue. This is the same entry, it's just a different amount. So this time it's for $600. Okay, so for K, we receive an invoice from Gas and Go for gasoline purchased on account during May for $110. The invoice will not be paid until next month. So what we need to do is we need to go ahead and book this expense. We're going to call it fuel expense. Remember, we're actually going to use the capital account for this chapter, but in future reference, we would use fuel or gasoline expense, something like that. But the case says we're not paying it right now. We're not going to pay it until next month. So we have accounts payable. And it's for $110. Remember, this is an expense. It's reducing the capital account. And in order to reduce the capital account, we need a left entry because capital is on the right side. It's part of owner's equity. It's on the right side of the accounting equation, so it increases with a right entry. So to decrease it with an expense, we need a left entry. Finally, L, at the end of May, Jim withdrew $100 from the business for personal use. So, the business or capital account, J. Hamilton Capital, is being reduced by $1,000 or $100, I'm sorry, and the cash account is being reduced by $100. To reduce capital, we need a left entry, and to reduce cash, we need a right entry. And this is a withdrawal. So there we go. We've booked all of these entries. Now, what about our financial statements? So let's look here. These are some financial statements that we can now create. So let's look at the different accounts and see how they've been affected. So let's start here with income statement. Fees earned. We used revenue, right? So we have, let's look at every time we have a revenue entry right here. We have this. Let's do it like this. Revenue. We're going to take revenue here, right? Revenue here. Revenue here. We should have 1720. 1,720. That's how much revenue we earned. So advertising, gasoline, and wages expenses, right? So where's our expenses? Supplies. No, that's not there. Check this out. So we bought these supplies here. Let's go back up here. Let's look at this entry real quick. We bought these supplies in C. We paid cash for supplies of $50. It doesn't say we've used these supplies. So instead of an expense, we're going to call it an investment because we wouldn't call it an expense until those supplies are actually used. In this case, which is called accrual accounting. So let's look at advertising expense. That's $150. Gasoline expense, $110. And wages expense was $85. So our total operating expenses, if we added those up, right, 150, 85, and 110, we get $345. So our net income equals revenue minus our expenses. Our net income is $1,375. Okay, so that is an income statement, a very basic income statement. Let's look at our statement of owner's equity. So our capital account beginning May 1st started at 0 because this business is a brand new business. So we began business in May. So on May 1st, we started with $0. Then we had our investment here of $800, right? We just figured out our net income from right here. So that was $1,375. Less withdrawals. We would put this in like a parentheses, 100. So our increase in owner's equity is net income plus our investment minus our draw is 2,075. That's our increase. 2,075. So our capital account at the end of May, ordinarily, like if it was next month, we would start with 2,075 and we would add the two together. This month we started with 0, so it's 0 plus 2,075, so our ending is 2,075. Now let's look at our balance sheet. Okay, so what we have to do is we have to look at everything that affected our cash account. So cash, here we have an addition to cash here. There's cash again. We subtracted cash here. We added cash here. We subtracted cash here and here and here and here. So our cash account is $115. What about accounts receivable? Accounts receivable, we added to it here. Then we subtracted from it here. Then we added to it here. And that's it. So we have $600 in accounts receivable. We have just our $50 in supplies from here because it doesn't say we used them up. So we have $50 in supplies. Ignore that. Okay. Then lawn equipment. Well, we purchased $1,000 worth here, right? Anything else? I don't believe so. So we have $1,000 in lawn equipment. Sorry, a little formatting here. It bugs me when stuff is out of line. Ignore. Okay. So then our total assets, if we add all this up, we've got 50 and 1,000. So I can do sum here and add. It's weird. Excel's being weird again. Our total assets are $1,765. I can already tell you that something's wrong. And the reason that I know something's wrong is because we have more than that in capital and our accounts payable is not negative. So we wouldn't balance at this point. Let's go ahead and get our liabilities and owner's equity in here, and then we'll figure out what we missed or did wrong. So, capital, or let's do accounts payable. Accounts payable. Oops. Accounts payable is, we added to it here. We subtracted from it here. But then we added to it here. So we have $110 in accounts payable. Our capital account is $2,075. Oh, come on. There we go. Okay. So that means our total would be come on, equals this plus this. Our total would be $2,185. So let's find out why we're not in balance. Okay, so the assets have to equal the liabilities plus owner's equity. Remember, this is the accounting equation. So let's talk about cash. Cash here, 800, right? Minus 50 plus 700 minus 1,000 minus 150. Oh, here we go. We missed that plus 420 here, right? And I think that's the only thing we missed on cash. So this should be 535. So what does that do? Oh, check it out. We are good now, 2185. So 2,185. So our total assets are 2,185. Let's go ahead and do a little formatting here. We'll go ahead and underline that like that. And our total liabilities plus owner's equity are 2,185. So we know we're in balance, and we've completed some financial statements and some basic accounting entries to this point. I know this video is probably a little bit much for you guys to start out. It's a lot to learn to begin with. If you have any questions at all in your homework, please let me know. I'm happy to help. Hopefully this will get you through it, and we'll have a great class session. So thank you very much for watching, and I hope you have a good week, and God bless.